A 74-year-old guy in my hiking group paid zero federal tax on over $100,000 last year. I didn't believe him at first, and neither did anyone in the group. It was a Saturday morning in October. Cool enough that you could see your breath on the first mile, and warm enough by mile 3 that you were unzipping your jacket and wishing you'd left the heavy flannel at home. There are 6 of us in the hiking group, and we've been going out together every other Saturday for about 4 years now. Retired guys mostly, a few still working part-time. We do a trail, we talk, we argue about things that don't matter, and occasionally someone says something that challenges everything you think you know. That October morning, it was Walt. Walt is 74, spent his career in civil engineering. He's one quiet guy that you won't hear brag or hold court. So when he mentioned, quite casually, the way you'd mention the weather, that he paid zero federal income tax last year, the whole group kind of stumbled. Someone said, "What do you mean zero?" And Walt said, "I mean zero? Nothing. We made over $100,000 and we didn't owe the federal government a dime." Now, the first response from the group was suspicion. Jerry, who worked in banking, said, "Walt, you got a guy in the Cayman Islands you're not telling us about?" Walt laughed and then said, "It's completely legal. It's not even that complicated once you understand it. It's just tax planning. Most people never do it because they don't know it exists." And then he started explaining it. Right there on the trail, between a creek crossing and a long uphill stretch. I'm pulling out my phone to take notes, stepping over roots, trying to keep up with him and write at the same time. By the time we got back to the parking lot, I had 2 pages of notes and a head full of questions. That evening, I sat with those notes and tried to make sense of them. And the next Monday morning, I called Frank. Frank is my tax guy, been with him 15 years. Good man. Knows my situation inside and out. I read him Walt's explanation back over the phone, and there was a pause on the other end. Then Frank said, "Ed, Walt's not wrong, and honestly, you should be doing some version of this yourself." That conversation changed how I think about retirement income. Now, before I get into what Walt explained and how it works, I want to say something quickly. I started this channel because I got tired of retirement finance content that felt like a college lecture, numbers on a whiteboard, no real life in it anywhere. What I wanted was a place where guys who were actually in retirement, actually living it day to day, could talk honestly about what's working, what isn't, and what we wish someone had told us 10 years ago. That's what this channel is. My hiking group, my fishing buddies, my neighbors, the guys I've known for 30 years. We're all walking through this together, and I share what we learn. If that sounds like something you want to be part of, I'd love for you to hit the subscribe button and join the community. We're growing something real here, and I think you'll find it's worth your time. All right, back to Walt. Now, what Walt laid out on the trail starts with one simple observation. Most people do their tax planning on April 14th, one day a year. Under pressure, reactive, you fill out the return, you pay whatever you owe, and you move on. And the next year, you do the same thing. But the people who consistently pay little to nothing in retirement taxes, they didn't get lucky. They planned. And they started planning years before they needed to. Walt started his when he was 61. That's one of the things he said on the trail that landed hardest. He looked around at the group and said, "The window doesn't stay open forever. If you don't act while your income is low, you lose the opportunity. And most people don't realize the window is there until it's already closing." So let me show you what that window looks like. And more importantly, how to use it before it shuts. The first thing you need to understand is what Frank calls the 3 buckets. Most of us have some version of this, even if we've never thought about it this way. Bucket 1 is your traditional 401k or IRA. You put money in before taxes. It grows tax deferred, and when you pull it out in retirement, you pay ordinary income tax on every dollar. Now, this is where most people's retirement savings live. And it's the bucket that causes the most tax pain if you don't manage it carefully. Bucket 2 is your Roth account. You put money in after taxes and it grows. And when you pull it out, you pay nothing. Zero. That money is yours free and clear. Then there's bucket 3, which is your regular brokerage account. Regular investments, stocks, funds, that kind of thing. Taxable, yes. But with some important exceptions we're going to get to. Now, the reason most people pay too much in taxes is simple. They spend their entire retirement pulling from bucket 1. The traditional IRA, every dollar they take out, the government takes a cut. And the longer they wait, the worse it gets. Because at age 73, something called required minimum distributions kicks in. The IRS forces you to start pulling money out whether you need it or not. Whether it's convenient or not. Whether you're already in a high bracket or not. Walt called it the ticking clock. He said to the group, "The government was patient while you were saving, but at 73, they're coming to collect. And if you haven't managed your buckets before then, you'll be paying their price, not yours." So how do you avoid that? You use 4 moves. And I'll take you through each one the way Frank explained it to me after that hike. The first move is the 0% capital gains bracket. And I want to stop here for a second because when Frank told me this existed, I genuinely didn't believe him. Here's how it works. If you're married, filing jointly, and your taxable income in 2026 is under roughly $99,000, your long-term capital gains rate is 0, not low. 0. That means if you've been building up assets in a brokerage account over the years, like stocks, index funds, whatever, and you sell some of those assets in retirement, you could owe nothing on the gains, as long as you keep your total taxable income under that threshold. And here's a bonus move inside this one. Frank called it tax gain harvesting. If your income is low enough, you can sell appreciated assets, recognize the gain, pay 0 tax on it, and then redeploy that money with a higher cost basis, which means less taxable gain when you sell it again later. Walt had been doing this for years, before I even knew it was a thing. Legally zeroing out gains, just because he understood where the threshold was and kept his income underneath it. Now that brings up the obvious question. How do you keep your income low enough to stay under $99,000? And that's where the second move comes in. And Frank told me this one is the most powerful lever most retirees never touch. It's the Roth conversion window. So here's the setup. The day you retire, your income drops dramatically, especially if you delay Social Security, which we'll get to in a moment. Let's say you retire at 62 and you delay Social Security until 70. Those 8 years in between? Your taxable income is at its lowest point in decades. You might be in the 12% bracket, maybe 22%. Walt retired at 63, and he recognized immediately what that gap meant. So he started converting money from his traditional IRA to a Roth every single year during that window. He was paying taxes on those conversions at 12%, a known rate, a manageable rate. Moving money from the bucket the government always has a claim on into the bucket they can never touch again. He told the group, "I paid a little tax on purpose, so I'd never have to pay a lot of tax by accident." And by the time he turned on Social Security at 70, his traditional IRA was significantly smaller. His required minimum distributions, which just kicked in last year at 73, are small and manageable. And most of his income now comes from Roth withdrawals, which don't count as taxable income. That last part matters more than people realize. Because Roth withdrawals don't just avoid income tax, they also don't count toward the formula that determines how much of your Social Security gets taxed. They don't trigger Medicare surcharges. They're clean, invisible to the IRS in the best possible way. Now, Social Security taxation is the third move, and it's directly connected to everything we just talked about. So let me show you what most people don't know. Up to 85% of your Social Security benefit can be taxed as ordinary income. Whether that happens and how much of it happens depends on something called your provisional income. Your provisional income is your adjusted gross income, plus half your Social Security benefit, plus any tax-exempt interest. If a married couple keeps the provisional income below $44,000, only 50% of their Social Security is potentially taxable. Keep it lower still, and almost none of it gets taxed. And the way you do that is by pulling from your Roth instead of your traditional IRA. Roth withdrawals don't go into the provisional income calculation. So you can take money out to live on, and it doesn't push your Social Security further into taxable territory. Walt had engineered his withdrawals specifically around this number. He knew the threshold, he tracked it, and he stayed under it deliberately every year. Frank put it plainly when I asked him about it. He said, "Most people don't find out this formula exists until the first time they're shocked by their tax bill in retirement. By then, the window has already been shrinking for years." But even with all three of those moves working in your favor, there's a fourth one that puts a serious floor underneath everything else. And for those of us 65 or older, it's bigger than it's ever been. Frank called it the deduction stack. In 2026, here's what a married couple, both 65 or older, can pile up before they owe a single dollar in federal income tax. Standard deduction, $32,200 for married filing jointly. An age-based additional deduction, $3,300. And a new 65-plus bonus deduction added in 2026. Up to $6,000 per person, which is $12,000 as a couple. Add it all up. That's $47,500 in deductions. $47,500 that comes off the top of your income before the IRS starts counting. Now you overlay your Roth withdrawals, which don't show up as taxable income. You add in your 0% capital gains treatment on your brokerage assets. You manage your provisional income, so Social Security stays mostly clean. And suddenly, a married couple bringing in $100,000 a year gets to zero. Legally, completely above board. Not a scheme, just a plan. And Walt didn't stumble into this. He built it piece by piece over a decade before it paid off. And that's the part most people miss. They hear zero taxes and they think shortcut. It's not a shortcut, it's a strategy. And strategies take time to set up. But before I show you what this looks like in real life, I need to warn you about the one trap that catches people who think they've figured it all out. Frank called it the IRMAA problem. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge. And it doesn't ask for your permission before it shows up. And here's how it works. Medicare Part B and Part D premiums are based on your income. Not this year's income. Your income from 2 years ago. So if you do a large Roth conversion this year, which is smart, long-term thinking, your Medicare premiums 2 years from now go up, sometimes way up. In 2026, if your income as a married couple crosses $218,000, your Part B premium jumps. At the highest tier, you're paying close to $690 per person per month, instead of the standard $185. That's over $12,000 a year extra. For a couple, just in Part B. And Walt knew about this, so he was careful never to convert so much in a single year that he tripped the surcharge. Rather, he spread his conversions out, kept the annual Roth conversion under the threshold, slower than he could have gone, but cleaner. He told the group, the goal isn't to pay zero taxes this year, it's to pay as little as possible across the whole run. And if you're not watching IRMAA, it'll quietly eat up every dollar you saved on taxes. Model both together, your tax bill and your Medicare premium looking 2 years out at the same time. That's the discipline that separates the guys who actually pull this off from the guys who thought they did. Now let me show you what this looks like with two real people. I'm going to use Walt, and I'm going to use another guy from our hiking group. I won't use his name, but he knows who he is. Both are 74 now. Both retired at 63. Both had roughly the same savings going in, about $1.5 million spread across a traditional IRA, a Roth, and a brokerage account. Both planned to spend around $90,000 a year. Both had Social Security available at about $2,400 a month. The other guy did what felt natural. Started pulling from his traditional IRA right away at 63. Claimed Social Security at 65 because the check felt good and he wanted it. No Roth conversions, no real strategy. By 73, when required minimum distributions kicked in, his traditional IRA had grown to over $1.1 million. The RMDs forced him to pull out $44,000 a year on top of his Social Security, pushed him into the 22% bracket, and 85% of his Social Security became taxable. And so Medicare started surcharging him. But Walt did it differently. From 63 to 70, he converted $60,000 a year from his traditional IRA to a Roth, paying 12% while his income was low. He delayed Social Security until 70, locking in the maximum benefit. His traditional IRA shrank steadily year after year. And when RMDs hit at 73, they were small and manageable. And most of his income now comes from Roth withdrawals, which the IRS can't touch. Over a 25-year retirement, Walt will pay roughly $180,000 less in taxes than the other guy. Same starting point, same spending, different sequence, a different outcome. And on that October trail, Walt said something I keep coming back to. He looked at the group and said, "The government wrote the rules. I just read them." So here's where I land with all of this. I'm not a tax advisor. Frank is. And Walt is a civil engineer who did his homework and started early enough to let it work. What I want you to take from today isn't a checklist to copy blindly. It's the awareness that this opportunity exists, that there is a window, and that window is open right now for a lot of you watching this. If you're retired and not yet drawing Social Security, you may be sitting in the most valuable tax planning window of your entire life. And if you're still a few years from retiring, you have even more time to set it up right. Find your Frank. Not just a guy who files your return every April, a CPA who actually understands retirement income planning. Someone who will sit down with you, look at your 3 buckets, and help you figure out how to sequence things so you're paying the government as little as legally possible. It's worth every dollar you pay them. And go through your own situation this week. What does your traditional IRA look like? Do you have Roth accounts? When are you planning to turn on Social Security? Mate, have you thought about what your required minimum distributions are going to look like at 73? These are the questions that determine whether you end up like Walt, zero taxes, sleeping easy, or like the other guy, writing checks to the IRS every quarter and wondering why nobody told him there was another way. Nobody's going to hand you this plan, but now you know it exists, and that's the first step. And if today's video was useful to you, do me a favor. Share it with someone who's either in retirement or getting close to it. You aren't doing it to show off, but because a lot of guys out there are sitting on this opportunity and don't even know the window is open. You might be the one who gets this in front of them at exactly the right time. And if you're not already part of this channel, I'd hit the subscribe button and ring the notification bell. Because what we do here isn't a finance lecture series. It's what happens when guys who've actually lived this sit down and get honest about it. Real experience, real mistakes, real wins. And what retirement actually looks like when you're finally living it on your own terms. Come be part of it. See you in the next one.